Good morning, everybody. Very warm welcome. Broadcasting under level 1, the second session with the Reserve Bank on where we're at in New Zealand and what the outlook looks like. I'm going to hand over to Rob Flanagan to welcome the team, but absolutely appreciate you on, as someone said yesterday, webinar land. Thanks for joining us, and to the RB, very big thanks for joining us. Rob, over to you.
Thanks, Richard, and welcome everyone here today for our second session, and we welcome the team from the Reserve Bank. Geoff, the Director Governor of the, or Deputy Governor of the Reserve Bank, together with Toby, Head of Financial System Policy and Analysis, and Richard, the Manager of Insurance Oversight. And they're going to bring us up to date and lead us in a discussion on the impacts of COVID-19 and excuse me, and hopefully from the discussion will help us inform us as we go into a very uncertain economic environment ahead of us. So welcome and enjoy the session. I'll hand back over to Richard, Chief Executive of the FSC, to guide the session through.
Thanks, Rob. Folks, I'll be really brief. I think everyone's aware how we play on Zoom. This is very interactive, and as interactive as you'd like. Feel free to use the Q&A button to ask all sorts of questions. Geoff's going to lead off with a presentation. We'll then have a chance to have some dialogue, followed by Toby talking about a range of issues and initiatives, and finally to Richard Dean similarly. So there'll be 3 opportunities to have a bit of dialogue, so absolutely encourage you to use the Zoom Q&A button. In the meantime, Geoff, over to you, and thanks again.
Well, thanks very much, Rob and Richard and FSC for facilitating the session. Thanks very much to all the participants for joining us. I am going to commence the discussion with effectively running through our financial stability report presentation. It's a couple of weeks since we delivered the financial stability report, and of course in that time a few exciting things have happened, including the move to level 1. But you know, the FSR is a 6-monthly health check on the financial system, both where we're at and also looking ahead over a period of time. So it doesn't date too quickly, and we think it's got some pretty important messages and for the discussion. So I shall just, if you give me a second, I shall share that screen. I'm going to do this and can take some questions at the end of it. Look, obviously the background to the FSR and the background for this discussion, as we know, is an extraordinary health crisis followed by or associated with a very severe economic downturn. At the time of the FSR, or the time of the monetary policy statement earlier in May, we produced a range of economic scenarios. Our baseline scenario had this as probably the largest fall in GDP in 160 years. You know, at that time we didn't know how long we'd be in level 2, and maybe it'll be a touch softer than that. But it's one way or another, it's going to be a very deep recession. The health crisis, you know, and the fact that we've all gone to level 1 is sort of, you know, creates a real sense of confidence that we're on the road to recovery, and in many ways domestic economy it will be assisted, you know, quite significantly by those easing of restrictions. But without sounding too gloomy, we still sit in a world where the world is still suffering significantly from high infection rates. World interaction, trade, people movements are incredibly impaired and will be for quite some time. And New Zealand remains is a small trading nation, dependent upon tourism heavily, on migration, on all sorts of people interactions for doing business. Companies need technologists from offshore, etc. So, we still see a significant impact on the economy, and one way or another, I think a lot of economic pain still lies ahead of us. So I think we have to be cautious about the fact that business failures and unemployment are still building, and probably the worst unemployment numbers are going to appear in the second half of this year, probably in the last quarter. So I hesitate to get too optimistic about our state of play too quickly. Of course, there's been an extraordinary amount of policy support by the government for the economy, and that has cushioned the economic blow. Treasury produced some very useful economic scenarios where they showed the projected sort of downturn with and without significant fiscal impact. Fiscal impact was taking sort of unemployment numbers down from well and truly double-digit 13% figures down to 9%. Our own estimates sort of put it, in our baseline scenario around 9, but actually what we said in the monetary policy statement and underpinning the financial stability report is probably the risks were more downside than upside to that. So, these policy measures and our own Reserve Bank easing and monetary policy measures have helped, but they don't eliminate the crisis. They soften it, so to speak. There was a very big focus in the FSR on the banking system. I will come and we'll talk specifically about the insurance sector in a short while, but we need to acknowledge that the banking sector is a crucial and very significant part of our economic system. New Zealand, broadly speaking, it's 85% of lending activity. And really, if there was one really big message in the FSR, it's that economic stability and financial stability are going hand in hand at this point. We need banks to continue lending to support the economy, and that in turn actually reduces the immediate financial stability risks. If we had a credit crunch, it would worsen things quickly. And I'll sort of repeat that message, but that theme was really the heart of the FSR. In order to be able to be confident that banks can continue lending, we undertook quite a lot of analysis, and in a sense the FSR was articulating our confidence that in generally speaking in the baseline scenario world, we think banks can continue lending. We had that confidence partly by looking at this chart. You can see how capital ratios have improved significantly since 2008. The proportion of high-risk lending and mortgages with high LVRs is way down from where it was as a result of our LVR policy. And liquidity positions, or long-term funding positions, indicated by this core funding ratio, are also a lot better than they were 10, 15 years ago. So we started into this recession, into this crisis with the banks in a much stronger position, partly because of the policy measures that we've put in place, and partly because we've had a number of years of reasonably sustained good economic performance. The insurance metrics are a little bit more mixed, and I'll turn to those in due course. What have I done here? Okay. Just another way of looking at the exposure of the banking sector is this chart on LVRs. What this does is show the proportion of households that would be in negative equity under a different house price, a variety of house price declines. So if you look to the left of the chart, you can see that if there was a 10% house price decline, actually only a very small percentage, 3-4% of households would have negative equity. The red bars show that if we hadn't put on the LVRs, it would have been at 10%. By our estimates, and so those LVRs have sort of put more resilience into the system. We've also done a number of things in the short term to assist banks to help the economy, supported them with capital rules on mortgage deferrals. We've deferred, obviously, the capital review decisions, increases in capital for 12 months, and a number of other measures. So basically all aimed at supporting banks and continuing to lend through this crisis, and therefore softening its impact. I'm going the wrong way. Let me go this way. If I just turn to the insurers quickly, as I said, it's a bit more mixed picture. This has got two panels in it, non-life and life. For the general insurers, they've generally started into this crisis in a better position than they were a few years ago. To a good degree, this is their position's been bolstered by a couple of years of low claims. So capital positions have improved, profits have been quite good in the last couple of years. Life insurers, on the other hand, have sort of been still a bit closer to the margin. They're a bit more mixed. Some are afflicted by the low interest rate world that we're in. Some have as we've discussed a number of times, really just not boosted their solvency margins or capital positions quite as much as we would wish. These figures here reflect even our own initiatives to, in some cases, demand or require firms to lift their capital positions. So it's not a dire position, but it's been a bit more stable, and you can see the profit margin's actually lower than it was a year ago, and expenses have been up a bit. So yeah, the life sector's been slightly less strong as a whole, and a few more of them are vulnerable than is generally the case in the banking sector. So just to elaborate these messages a little bit, so what we did we conducted a number of stress tests, one which we discussed in a previous webinar of the insurance sector, and one of recently of the banking sector, where we undertook scenarios to see how resilient the banks were to prolonged downturn. If I turn to this chart here, it looks a little busy, but the messages are relatively simple. The red line at the bottom is the baseline monetary policy scenario, which had unemployment peaking at about 9% before improving. And then the other scenarios are more severe. Our stress test scenarios, the top two, the green one was our baseline stress test scenario. So you can see it's sort of more severe than any of our economic scenarios in the MPS. And then we did a very severe stress test on the banking system, which is in the sort of purple magenta line. And they had respectively unemployment rising to about 13% or up to 18% before gradually declining. There are other elements in the stress test. We had the green line, the baseline stress test had a house price fall of 35%, basically close to 50% in the purple line. What these did was really say, how would the banks hold up under a protracted and severe downturn? Pleased to say that the messages are that that the banks are resilient to most scenarios, but not to all. They can withstand a broad range of adverse scenarios and have sufficient capital to keep lending. And that's a really important message for us. It gave us confidence that we can keep encouraging and messaging banks to be courageous, as we've said, to lend to their support their customers. They're not in a position where they have to immediately tighten and protect their balance sheets unduly. That's sort of the reason we want higher capital levels. So banks have got these buffers. It's a time to use them, and they can. But we also did note that they're not invincible. If there was a really severe, protracted downturn, sadly, if we had to go back into lockdown for another couple of months, we get a second wave of infections or something or other, and unemployment really stays up at a high level, you can see scenarios where the banks would unfortunately have insufficient capital. They would fall below requirements and need to find some capital to inject. That's not what we expect is going to happen. but our job is to worry and think about tail risks, and you can see that there are some. And then we commented that while that was a major story, there were other important subsectors. Obviously, we paid attention to the non-bank deposit-taking sector, which is credit unions, building societies, finance companies. They tend to have lower buffers. Some of them are a little bit more exposed to specific subsectors, particular industries, or whatever else. So there's a little bit less resilience in that sector, and not to say that it's in crisis, but to say that looking ahead over 12 months or so, it does need to continue to try and build its resilience in various ways. And then, as I remarked on the life insurance, again, some of those too are in that similar position where some of them just need to bolster their positions, and we've been requiring that in some cases. And even within the insurance sector, some providers of credit insurance are more susceptible than others to a significant increase in unemployment. So those were the key messages, key conclusions. As I said, we were encouraging the financial system to keep supporting its customers. It's got a very important role in avoiding worsening this economic downturn. Maintaining credit is a very important role. Maintaining insurance facilities to support businesses is equally important. Banks rely on insurers, of course, for mortgage insurance in many cases. Builders require it for. We all need it in all sorts of ways. Won't label what you know very well, but if I ended on an optimistic note, we're really pleased and positive that the financial sector has been playing its part. This, as I said, is a sort of a statement of where we're at, but also a statement of looking ahead. And I guess my preaching part is the next 6 months, next 12 months is going to continue to be very important, because the economic crisis is far from over. And so keeping that long-term focus on customers and maintaining resilience, acting prudently in an ability to keep supporting the economy, supporting yourselves so you can support your customers is a key thing. I'll stop there and take some questions and open it up for questions before Toby comes in and talks a bit more about our policy agenda ahead.
Thanks, Geoff. There's a couple of questions have come in. Just picking up your last point around outlook and confidence. It kind of feels, being on level one, that there's a sense of optimism in the air, a sense of confidence in the air, and maybe that's just because we've been in lockdown. Is there a sense within the RB that, based on your worst case scenarios and best case scenarios, we're in reasonably good stead with all the initiatives that have come out of both the bank and at a political level?
Well, I think in the sense that if we manage to maintain this strong health position, we should be able to avoid the worst outcomes for sure. We're more at the baseline level, extent of the spectrum, if you like, than we are at those really scary, very severe scenario terms. But I guess how optimistic one feels about that is got to be tempered a little bit by the fact that it's still got a lot of people afflicted. Unemployment's still at 9% or thereabouts, still 10% sort of house price fall at that sort of scenario, many business failures, and without sort of wanting to be unduly gloomy about that. I mean, the announcements of layoffs in recent days by some of the larger firms, and there are many small firms that are still trying to work out how viable they are, adjustments. There's going to be a period of continued sort of bad, sad economic news. But yeah, half full, it's not nearly as bad as it might have been. We've done a really, really good job of softening the worst and avoiding the worst of this by mitigating the health problem quickly. The lockdown's been very successful in that sense, but let's not delude ourselves that it means that we've avoided a recession. We haven't avoided that. We're still going to have quite a deep recession.
Thanks, Geoff. Question here from Murray. Has the RB been surprised at the speed and strength of the recovery in local and global equity markets? What's your read on that? Feels like KiwiSaver balances have almost bounced back. Equity markets have bounced. Sense of optimism in markets generally.
Yeah, that's very accurate and perceptive that it has happened, and I think the share market's got US S&P's back beyond where it was in February, and yeah, to be honest, I am a bit surprised. We have a health warning at the start of this presentation that I skipped over, which is don't regard this as financial advice from me, but I don't like to be asked to predict equity markets, but there is a sort of a little bit of a sense that the prices are a little detached from the earnings profiles. Of course, they're forward-looking. They think that we're through the worst of the prospects, and economic recovery's on course. But as I said, we still see quite a lot of downturn in international trade. Investment's going to be low. Capital goods demand will be low. So I wouldn't be surprised if there's not a little bit of volatility up and down for a while, and that whether those prices can be justified, I guess time will tell. But there's some signal there that we are through the worst of this. I just think that history tells us, and we're still rolling out through. Southern states in the US have still got very high infection rates. Reinfection is still a significant possibility in parts of Europe. There's a long way to go.
Geoff, question from Peter. This is when you borrow, obviously there's pay down and payback timeframes. At what level and when does national debt top out in the updated baseline scenario? And what's the pathway to paying this back, do you think?
Yeah, good question. I mean, it's going to be a long road ahead in the restoring debt positions to be able to absorb future shocks. Look, I mean, our fiscal frameworks are very, very important underpinning of New Zealand's economic performance and stability. By having this long-term commitment to keep debt at a moderate levels. When it's low, you can use it. Somebody had to borrow more here to try and help the economy through, and clearly fiscal policy was a right thing to use. So you use it, but if you don't ever get it back down, you've got less discretion in the future. That's certainly true. So we would very much support that there will be some time in the next few years when there will have to start to be more concrete plans for fiscal consolidation to restore the Crown's balance sheet, so to speak, over time. We've shown we can do that before, post earthquake, post GFC, but it's not a quick process. It takes a lot of discipline. I think in the fiscal projections, got 2 years of very significant operating deficits, so we're still building debt for the next 2 years. So I guess we're talking from 22, 23 onwards, really starting that process on the current scenarios, the way the world looks at. So yeah, that's before us, and it's going to be important.
Thanks, Geoff. Lots of great questions coming through. Question from Chris: does the RB have a view on insurers' response to assisting vulnerable customers facing hardship, and what more could or should be done?
Why don't I ask Toby or Richard to come in here rather than me doing all the work?
Toby, Richard?
Are you going to take it, Toby, or do you want me?
You go, Richard. You're first.
Okay. Fundamentally, these decisions around this sort of thing, Chris, come down to your own corporate commercial judgment. There's a growing sort of move toward doing this. Some went early, some have moved a bit later. Whether that is forming into a quasi expectation, I don't know, because I'm not out in that part of the public. And it's certainly not something that we would mandate. That falls outside our prudential remit. But It is, I guess, in part, this is about the insurance industry being seen to be contributing to the mitigation of some of the difficulties that the wider world is facing. But they are commercial decisions on a company-by-company basis in respect of premium holidays or ex gratia claim recognition, or that sort of thing. What more could and should be done? I think that's a question for your own boards and management, actually, because each company will have their own idiosyncratic situation to consider, their own list of policy holders with their own issues to think about. So I think actually that's one that, without flicking it down to finally to get off the strike, Chris, I would send back to each company and say, these are commercial decisions for you to be thinking about.
A related question to that, Richard, around the conduct and culture conversation. It's been said that, you know, in times of crisis, that's when you really see the true colours of people, of organisations. And to Geoff's earlier point, it seems like the sector has rallied and done its best and utmost to support New Zealanders through a very difficult time. What's your read of the future of the conduct and culture conversation now that we're kind of in the midst of this COVID crisis?
I think I've said this maybe in this environment before. The conduct and culture exercise, combining FMA and the Reserve Bank, has effectively changed the wallpaper in the room in which the industry lives. So it's a reality out there now. The expectation definitely has changed on that. I think the industry broadly, life and non-life, has responded pretty well to the conduct and culture expectations, but it's not a once and done. That is now the expectation that the world has, I think, and probably potentially justifiably. Following or adherence to the revised conduct and culture approach can only enhance the public view of the industry. Industry image and reputation is critically important in BAU times, and the extent to which the industry can step up and, as I say, assist in the mitigation of some of the discomfort by dint of whether it's specific activities like Chris was talking about, or just general behaviour and delivery and presentation levels, however that plays out, I think has to be of advantage, and a focus on that and proactive moves in that area has to be of advantage to the industry overall and on an entity by entity basis, each company, I think.
Thanks, Richard. Geoff, last question, if we can, given it's just gone 8:30 and there are 2 other segments to go. We were talking a little before we came on around resilience, financial resilience of businesses, of family units, and obviously at a national level. What's your sense about how resilient New Zealanders are to weather, obviously, the deepening recession ahead? And second part to that, if there's any comments you can make on things like outlook on house prices as perhaps a barometer or reflector of some of those things.
Well, thank you. Good question. And you folk have contributed to, supported some really good work in this space. So let me acknowledge that. I think some of that research into the resilience/vulnerability of households has been really informative. I mean, I think what we've learned and what we know is that a large portion of households don't have much cash reserves to see them through if they don't have income coming in. We sort of probably suspected that, knew that, but we've got more information about that. And the same for small businesses. I mean, a lot of them survive basically on the revenue flows, pay the bills, and have small margins over the top of that. So, you know, the portions of the population who've got, you know, savings to call back on are not very high. And that's exactly why that conduct culture discussion is so important, is how do we help people through temporary loss, you know, downturns, losses of income, or inability to pay a bill in a particular month and needing a bit of stretch through to a subsequent month. the vulnerabilities are there. What the link to the housing market is, I suppose what we're saying is, in general, people's equity position in their houses is not too bad, because we've had this requirement they have 20% deposit for some time, speaking approximately. So the equity's there, but it's the debt servicing is the part that's going to be challenged. Can you pay your mortgage, even with low interest rates? If you haven't got a job, or you're relying on 2 incomes and there's now only one, then that's harder, and that's why those mortgage deferrals by the banks have been important. Same, I guess, with premiums and on insurance, can they be deferred and so forth. So I think, there is a limited degree. There's not as much resilience as we would like. We haven't been great savers historically. Increasingly that's gone into KiwiSaver, it's locked away, or into housing, and you can't use it that much. So, these things make us exposed. So I think the next 6 months, 12 months is really important. And if my comment, just to add to Richard's on those C&C remarks, is it's the next period which will really test financial institutions. When people 6 months deferral expires, what then? They're giving me some hard conversations. A number of people won't need it and they'll be fine, and they, it got them through the time. A number of others will still be facing some challenge, or new challenges have appeared, so I think it's going to be a real onus and expectation on financial institutions to ride this through with their customers in a long-term focus for quite some time yet ahead.
Thanks, Geoff. Toby, we might go to you for your comments more broadly on upcoming initiatives from within the RB, opportunity for further questions, and then finally to Richard. Toby, over to you.
Yep. Okay, thanks very much, Richard, and thanks, Rob. Good to be here again. I'm just going to talk about a couple of things that are on our agenda at the moment. First of all, the appointed actuary review, and then secondly about the solvency standards review. So appointed actuary first. Many of you are probably familiar with this. We've had it underway for just over a year now. Today actually is the day that the review is going to be released publicly at 10 a.m. We wouldn't normally talk about it before the release, but it's only a couple of hours away, so we thought we'd give you a quick heads up. But please, it's confidential until then, so just keep it under your hats till then. Just to step back, what have we done? So it was a sort of deep dive thematic review looking at the role of the appointed actuary, how well it functioned, what sort of improvements could be made. We do sort of 2 or 3 of these reviews every year across the banking and insurance industry, and it's part of a sort of theme of greater engagement with you all, with the industry, just dive a bit deeper into particular themes. We chose appointed actuaries. The IPSA regime has been in place for about 10 years now. The appointed actuary is a legislated position, a really important one as well. Insurance doesn't function well without actuaries. There are also a number of recommendations from the Trowbridge-Schultons report, which was the response to CBL, the independent report we had after CBL's failure. Number of recommendations of that about how the appointed actuary might work better. And also we wanted to feed in any recommendations from this into the review of the legislation and the solvency standards. As you may know, we interviewed 15 insurers. We held, I think, well over 100 meetings across those insurers. A number of you probably involved in it. Met both with the board members, with the chief executive, risk officers, appointed actuaries themselves. We had really good engagement with the NZSA, Society of Actuaries, and also with the Financial Services Council. We were hoping to be in a position to release this report in March, but obviously COVID got in the way. Being released today, as I said. Just quickly to run through what the conclusions were. We concluded that both the regime and most of the actuarial profession were largely effective, based on the samples that we had, of course. So that's good news. But there are a number of areas where we have got some recommendations, as you might expect. But I think probably the sort of key overarching message that we've got is about the impartiality and the potential capture of the actuarial position. We were concerned that sometimes the appointed actuaries didn't feel that they had a direct line up to, for example, the board, the audit committee, or indeed to ourselves at the Reserve Bank as the regulator. So that's something that that's probably our top recommendation, that the appointed actuary role should be seen as, and that it should be presented as independent. That means that we would expect to be able to have a direct line ourselves to the appointed actuary, and there's a number of recommendations that flow from that. So, for example, we would expect to have exit interviews with all appointed actuaries, so that they would have a chance to talk to us freely and frankly about any particular issues they had, any contentious issues that they'd confronted when they were presenting their reports, for example, how that all worked. A number of other things. I mean, we felt that there was sometimes a lack of depth in the actuarial function in firms. So, for example, I mean, just fairly topical issue, that there was a sort of lack of preparedness for crises. So there wasn't necessarily a sort of reserve actuary, any contingency plans if the actuary wasn't available, any contingency plans if they were extremely busy, like they have been in the last few months and weeks. And then there was also, we felt, not enough emphasis on identifying and managing conflicts of interest for actuaries and for the insurers. So look, I mean, that's a quick overview of the findings that we had. As I said, it's going to be out at 10 o'clock today. Highly recommended. Although it's about 40 pages long, it's quite an easy read. Along with it, we're putting out a 4-page note of recommendations. So that's a quick summary of all the things that we think that insurers should put in place as a result of this work. Yeah, so that's the appointed actuary report. Moving forward, the two key pieces of policy work that we had underway before COVID, as you're probably aware, were the review of the legislation and the review of the solvency standards. When COVID hit, we put both of those on hold, as we did both initiatives across all sectors. And we committed not to put out any consultations until at least the fourth quarter, so that's the 1st of October. I'll just concentrate on the solvency standards because that's the one that I think is going to be most important and urgent, and it's the one that we're looking to push ahead with first. So drivers for the review of the solvency standards, one of the sort of key urgent ones was IFRS 17, which, as I'm sure you know, was due to come in on the 1st of January next year. It's been pushed back by another year. Otherwise, we had the Treby-Sholton's report again, and there's a large sort of number of issues that have arisen over the years with the solvency standards, both large and small. So we wanted to do a fairly comprehensive review. Before COVID, we felt that we needed to push ahead rather urgently in a fairly sort of partial way to deal with IFRS 17 because that was urgent. Since then, we've had a bit of a rethink in the last month or so, and we've taken a step back and thought, well, actually, given that IFRS has been pushed back another year, we're likely to want to do a full sort of comprehensive review of the solvency standards so that we can get it all done once and get it done right. So what we're probably looking at, and we'll be consulting about this and engaging further, is a sort of 3-year program. Clearly, we'll have to put in place the IFRS changes first, but a sort of 3-year program to look at all the individual elements of the solvency standards, with the aim of coming up at the end of it all with a sort of single solvency standard that covers life and non-life, so you don't get difficult cross-references, and you can cover any sort of individual peculiarities, like, for example, annuities within that single solvency standard. I'd like to just say thank you to the FSC for their proposal on this. So their proposal, which you may all be aware of, was for a single sort of balance sheet approach to solvency. That's something we're looking at. We're looking at pretty hard, actually. There's some real benefits of it, getting rid of dual reporting, and we expect to be able to be coming out and consulting on that basically as soon as we think it's reasonable to do so. So just on that, just to finish up on the timing, we said we wouldn't come out with anything until October. Given I think that you all would like us to clear up what we're going to do with IFRS 17, solvency approach to that. The solvency standard is likely to be first cab off the rank. So we're looking to come out with some proposals at a high level, with bits to be filled in later going forward over the next 3 years in October. If you have any appetite for us to come out slightly earlier than that, we would be open to do so, because it may actually be in your interests to have some certainty earlier. But we have committed not to issue any consultations until October because of the stress of COVID and so on. So look, I'll stop there, and happy to take questions on either the appointed actuary or the solvency standards review. Thanks.
Thanks, Toby. And getting that clarity around timing of consultation and the leaderboard of what's most to least important is really valuable. Across the FSC committees, there's lots of activity on this, so that's awesome. And obviously 1 October, we will gear up for that. There's no particular questions at the moment coming through, so perhaps if we go to Richard, if there are any particular questions on Toby's comments, please feel free to send through. But maybe Richard will go to you and then close off with a couple of closing questions, and then all jump on the rest of our day. Richard.
Thanks, Richard. How has supervision been through the lockdown? Well, I would like to think that most companies won't have noticed any difference. My supervisory team has, I mean, we can work, we've had very good systems. We've all been able to work from home still in a coordinated and joined up manner. And that's all just ticked along. We've run 3 or 4 prudential consultation meetings remotely. There's a pretty clear indicator there that getting on a plane and travelling to some of these meetings has been the default option in the past, may not necessarily be the default option in the future. But look, technology's changed a lot of our world. Zoom nowadays means a heck of a lot more than a word that suggests running rapidly round and round a space. Zoom, Microsoft Teams, all of these things, it just means that there are different ways of delivering it. What we deliver will still be fundamentally the same. Our job is to ensure that entities are strong, not only in the here and now, but also that, particularly in the current context where there is so much uncertainty around, that entities are secure now, but also ensuring that they are positioning themselves for what might, not necessarily will, but what might come later. And that's, in that context, this is why we are out there asking you to voluntarily provide to us the results of any stress testing you're doing. It is very useful for us, as well as for you to know. It's incredibly important for you to know it clearly. It's very useful for us to know it as well, so we can get a sense of where the industry is at. We'll continue to focus on and bang on about capital. When you're in an economic crisis, there's very little that helps an economic crisis much better than having money available. And this is why we are very focused on maintaining maintaining capital levels, and that's in an absolute value context, not in a relativity to solvency standard or buffer type model. We're looking at the absolute value of capital being maintained. But these are all about in ensuring that we as supervisors can be comfortable that the industry is secure now. That's our day-to-day work, but it was also positioning itself for what might come in the future. We don't know what might come in the future. We all hope like mad that what could come doesn't, but it might. So that's where our focus will remain. We'll all be back in the office under the same roof from next week. I doubt that you out there will notice very much difference there. What we do ask is that you continue to maintain the level of contact and proactive communication that you've had and that has been building up progressively over the time through all this, and just keep the model going in that way. And that's about all I've got, unless anyone has any questions to come back on, Richard.
Thanks, Richard. I think that's a pretty important point. Select committee was on yesterday. It does feel that one of the big learnings and articulation through COVID is not only the use of technology, but also the very close working, much closer working relationship with regulators, supervisors, politicians and sector to focus on the key issues of the day. And hopefully we can maintain that that kind of working relationship kind of heading into the future, because it does feel a day has become a month has become a week has become a day in terms of the way in which the sector gets its message on clearly to get good decisions to serve consumers. So interesting there. Look, no particular questions coming through, but a couple, Geoff, back to you from your session, and perhaps we might end with a where will we be in 12 months' time. But the particular question is around the regional and the global conversation. The New Zealand success around exterminating, for the moment, COVID is being lauded globally. How do you see the Trans-Tasman bubble playing out? How do you see borders opening and trade resuming in a more normal sense? And what kind of impact do you think that's going to have on the New Zealand economy, probably in the next 3, 6, 12 months?
Well, I have no special crystal ball on these things, but yeah, in terms of we would definitely benefit as a country if we could have confident of the health, sustainability with that key condition. If we were confident that we weren't going to reinfect, then being open with other also healthy countries would be good. There's no doubt about that. Trade with Australia, it's officially it's our second biggest trading partner after China, but they're pretty much 1 and 2 very close by together. A lot of links, a lot of people flows with Australia. A lot of businesses rely on it. In terms of we've got many of you have cross country ownership, etc. So we know that would be beneficial. It'd be beneficial to some of our Pacific partners and countries, but yeah, health is going to take a bit of a priority to make sure that we don't expose ourselves, because obviously, if we get new infections, then there's some very difficult decisions ahead on how to manage that. So I suspect there's a bit of a cautious approach, but we would look forward to it. There's really good prospect that there will be some opening in a limited way somewhere in the next 6 months. I think we all don't have any inside knowledge of that, but we can see some optimism there, because infection rates are relatively low in Australia and a few other places as well. But borders are our friend. We protect ourselves from the rest of the world by keeping them closed. This question, can we manage them with quarantining and other approaches and so forth? The rest of the world, I think it's going to be it's a lot longer. It's going to be a lot harder before we get free flows back to North America, South America, Europe, and whatever else. And these are all, I mean, you add up the trade numbers, Australia and China, 40% between them, there's still another 60% around the rest of the world, right? Yeah, we will still be susceptible to how well the world is going, and the world itself is going to have quite a recession, very, very low growth worldwide. You've seen, I mean, China's been low infection rates for a couple of months now, but it can't trade really with many others in significant ways. East Asia itself is still quite restricted. So yeah, look, there's some optimism there. There definitely is some prospects of some opening up, and that will be helpful and it will be beneficial to us. We should look to achieve that, but we should also be careful not to throw away the huge gains we've made.
Geoff, Toby and Richard, that's a great way to close. Gives us a sense of guidance and optimism together with what's really on the plate over the next 3-6 months in our interactions with the RB. Absolutely appreciate you taking the time and sharing your insights with us. To the people on the end of the phone, thank you for joining. This session will be uploaded and has been recorded. So if you want to share it with any of your colleagues, that'll be live from tomorrow or recorded from tomorrow. Stay safe and thanks again. Perhaps Rob Flanagan, over to you for any closing comments.
Sorry, yes, thanks, Richard, and thanks everyone for coming. I think these sessions are really important, and we should keep the communication going as much as possible. So thanks everyone for attending.
Thank you for the opportunity.
Okay, thank you. Yeah.